Now, don't forget, we're doing a live client-only event in mid-October 2022. I'll be speaking. Ryan Griggs will be speaking. Dr. Paul Cleveland will be speaking. Our whole team will be there. You're going to have the opportunity to meet all of us, and you'll have the opportunity to meet other people, individuals that are practicing the infinite banking concept from all over the country. Iron sharpens iron, so you should be there. It'll be worth it. Look forward to meeting you. Look forward to seeing you. Be there, be square. In this episode, Ryan and I discuss yet another IBC hit piece. We look at the difference between APR and the true cost of borrowing, and we highlight important lessons from a recent client interview. Thank you for listening. We had fun and hope you enjoy. Welcome to the Banking with Life podcast. I'm your host, James Neathery.
I'm your co-host, Ryan Griggs.
We keep Ryan around because he's an academic. I'm kidding. No, I'm only bringing that up because of the, whatever. It's unscripted, so we're going to talk about whatever we talk about. But you wrote an excellent rebuttal to a Policy Genius hit piece that we're going to link in the bottom. Now, I didn't read the article, and I really don't have to because of your rebuttal. It was just outstanding, so entertaining, educational, point-by-point education to the erudites who write that kind of stuff, but then the erudite is really not interested in being educated. I mean, it was just so entertaining. You did a very good job. I'm very proud of you.
Thank you.
So, and then that's why I'm bringing it up. It takes a proper academic response is called for, and you delivered. So,
well, thank you.
Yeah, you're welcome.
And I saw on social media that you had very nice things to say more than once about it, but so it's a July 15, 2022 article on a platform called Policy Genius, which if you listen to podcasts, I listen to a lot of podcasts and online, YouTube stuff, and they're everywhere.
Yeah.
There's constant onslaught of marketing.
Yeah. Marketing.
Yeah.
Disguised as, a critique.
Independent
research
advice. Yeah. Even a very prominent, more than one very prominent libertarian or maybe Austrian oriented podcasters, they run ads for this. Of course. Yeah. Yeah. So for Policy Genius.
Yeah. Well, they're getting paid.
Yeah. And Policy Genius they're just one of a bunch of these online term promoters. People figured out that there's a thing called the internet, and that these term companies want to pitch term life insurance, and then of course, there's different companies, so they have different pricing, and so you can take those prices, and if you create a little algorithm and a little computer program and a nice little interface, then you can present as a marketplace where you're price shopping.
Sure.
For all of this, of course, as viewers know by now, is all about the death benefit, right? How much death benefit for how little premium, just while I need it. Just while I quote unquote.
While you're building your empire and gonna grow your investments to a point where you're self-insuring. Self-insuring means you have no insurance.
Right. Yeah.
That's what it means. But it's always thinly veiled in the argument too, is always the solution, the conclusion is always buy term and invest the difference.
Always. Because that is the only ostensible alternative to permanent. Well, if it's not permanent life insurance, if it's not whole life, well, then what else is it? Well, it's temporary term insurance. So there's always got to be some justification for that product, and it always ends up there. What really struck me, and I've been aware of Policy Genius before, and I get inundated with the damn ads, but
because you look at them too long, and the algorithm.
Well, you can't dodge them on a podcast. They bring them up so that you got to listen, or you got to pull the phone out and fast forward. Well, so an agent who works with me, Joe, thank you, Joe, for sending this my way, told me about it. Was it yesterday? I think it was yesterday.
Yeah, you wrote it yesterday.
Literally yesterday.
I read it fresh off the press, and I'm like, I'm hanging out in the pool, chilling. It comes up, and I'm like, oh, it's so entertaining. You know what that's the most entertaining to me, is a proper response to, they're just drive-by opinions dressed up to be a legitimate critique and it's always a sales pitch. But not to throw you off, but look, the second most favorite thing I do when it comes to life insurance on the internet is look at the comments on any kind of a term or whole life or whatever the marketing thing is. And then all of the comments, you can tell who knows nothing and who from the ones who think they know something. And it's generally always the one who knows something never comments. You know what I mean?
Yeah. They're always, yeah. Well, what's that saying? The worst fans have the cheapest seats or something like that.
Oh, that's Babe Ruth. The loudest boos come from the cheapest seats. No question.
Yeah. So nothing new there. But what I didn't know, so I was aware of Policy Genius, but what I didn't know is their particular approach to their quote unquote marketing. And this is very common. This isn't just Policy Genius. It's like something you see it on Facebook with the fact checking. You see it with the Snopes, there's this whole this presentation, this facade of an idea that there's this independent authority that's going to help you. Stupid consumer you are, by the way. I mean, that's the whole undertone, right? You're too dumb to figure this out, to use your own reason, to evaluate claims on your own. So we've got to have some patronizing parental authority figure come in and independently evaluate the claims. I mean, it's so patronizing and infantilizing. It's insulting. And so when James is saying that what I wrote was entertaining, it was like, I can't help myself but be a little sarcastic, like a little snide about it, because the attitude is it's condescending. It's insulting to the intelligent person who you don't have to be a life insurance. They present this thing, they make it seem like you've got to be you had to take actuarial classes in college, or you need to be a mathematician or some kind of engineer to understand life insurance. And then so that they make you feel that way, so that they can then present to you these little oversimplified, stupid, ostensibly expert analysis, third-party opinions to help you.
Independent, right?
Yeah. It's so insulting. I mean, it really drives me crazy. And so with Policy Genius in particular, just as one example, they have on their website an editorial standards page. And I'm like, oh, good. Oh, good. Because my favorite thing is to use their own language against them. We're not beholden to any one company and we'll advocate for you. Here we go. The same goes for our editorial content. We give you the unbiased information you need, and we will never recommend a product, company, or financial strategy we don't think is right. Yeah, okay. And then, of course, one part of their the article was blasting sellers of whole life because of those darn commissions. Of
course, you always you must attack the character, because we all know that everything you pay in premium in a whole life is paid to the agent as a commission. And the people in the industry, I've seen it, and I haven't read the article on Policy Genius, as I stated earlier, but I will. But I typically see, the first 3 years of commission goes to the agent, the first 7 years, or the first 10 years. It's like they pull numbers out of the air, and then they throw percentages on there, and it's just like, where do you get this? I mean, and two, I must say that most people's understanding of life insurance is based on someone else's misunderstanding. So if anyone makes a decision based on these types of promoters, then you're making a decision based on someone else's opinion of life insurance. It's just a very poor way to address your needs, whatever they may be, but you're sure not going to control the banking function, period, ever, with those. Because, and I think you even mentioned it, it's always by term, right? And let's dress it up, two-step process, by term and invest the difference. Like, okay, if I heard that 10 times from, 15 different people, then it must be the thing to do. Mm-hmm. Nobody in the life insurance industry prior to Nelson Nash has focused on the banking function. Yeah. I'm not saying that you haven't. Hey, if you have permanent coverage, whole life policies, you have a contractual right to collateralize. Yeah. Right. So no question, people have borrowed against their life insurance policies for a long time.
We're constantly reminded about it. The Rockefellers and Ray Kroc. And
hey, listen.
J.C. Penney, they had the one-off. Oh, some advisor told them they can get a loan from an insurance company. It's like, yeah, no kidding. That's not the banking function.
No. But let me say that, Ray Kroc, the Pampered Chef, and Walt Disney, they borrowed against their cash value, because they had it. They put money there. They were building capital there. Okay. Now, if you think the Rockefellers got their wealth from buying life insurance, you need to get past that marketing. All right. Because did they buy life? Of course they did. They put money
What didn't they buy?
Exactly. But if you think that's how they became billionaires and millionaires and, the Vanderbilts are broke after 3 generations because they didn't, that is all marketing. Now, you might take a highlighting a truth. Yeah, they bought life insurance. They did not become, rulers of the world because they bought life insurance. I'm just saying, and then I need to quit, but I won't for a minute. And you see these magazines, and I don't know all the magazines that come out with the richest people in the world. If you think those people listed are the richest people in the world, then you're gullible, you're naive, and you're being deceived. The richest, most wealthy people in the world are never listed.
Yeah, you'll never hear their names.
And they buy life insurance companies. Yeah. Actually, they own them.
By the reinsurance companies, yeah.
Oh, and then perform the banking function with the little lizards that, insure automobile insurance.
Mm-hmm.
Okay.
Anyway, so, what really, and then, of course, the title of this article was Infinite Banking Life Insurance is the latest TikTok trend.
Really?
Is it also a scam? We talk about titling the episodes that we do. That is not a title. That is a statement and a question. But that's the title. And then, but part of their editorial standards is, they refer to the third-party experts whenever necessary, except when they want to blast something, right? Then it's okay to use TikTok. The TikTok people.
Yeah, they're the experts.
Those are the ones that are expertly representing what infinite banking is. So we could take their word for it and correct them and pick on them. And then we can go, of course, get the fee-based planners and the contemporary financial guys. The words business cycle has never fallen out of their mouth before, or banking function.
Never.
And they're going to be the ones that are going to come in and give you their expert opinion.
Yeah. But it's okay. I'm unbiased because it's fee only. Oh, okay. That's how you get paid. So you're a capitalist, right? But commissions are bad because that's how a commission salesperson gets paid. But they're a capitalist.
Yeah.
There's been lots of articles and things written on, if I get paid fee base over time or pay fees, the consumer, compared to commissions. It's like, I don't know. Let's cherry pick the timeline, right? They get all the commission goes to the agent the first year, the first 3 years, first 10 years, but we're just going to charge you 1% or whatever the minuscule percentage is to manage your money. But let's don't cherry pick that timeline.
Right.
Let's don't talk about a 30-year, 40-year, 50-year timeline of managing money at, 1.5 or whatever it is. You must change the focus or a component if you're doing a calculation, right? So you got to change the focus. So it's purely the price of insurance. Let's focus on the price of the death benefit.
Right.
Term is no question the cheapest way. Not really, but it's
They're apples and oranges.
They're apples and oranges. One's temporary,
one's permanent.
Yeah. But if you're talking about the true, pure cost of life insurance, is it a term premium or is it a dividend being paid into the paid up additioned rider or a premium being paid into a paid up additioned rider? What's the cost of that death benefit? Okay, and it may be temporary because if you withdraw from a PUA, it's going to reduce the death benefit that PUA premium purchased. Okay, so that's temporary, right? I'm just saying.
You're saying there's value to things like the dividend that are not accounted for in the
price of death benefit, right? Nobody ever talks about, look, if I pay $1,000 to the paid up additioned rider and I'm 25 years old, super duper preferred, it's going to buy 3, 4, 5 times the death benefit. What's the cost of that? Well, then you have to look at the PUA charge. Every life insurance company has a charge when you pay a PUA premium. You can't really see it in the tabular detail of an illustration, but you can find it in your policy contract. And if you own a policy, I don't care what kind it is, you should know the characteristics of the policy, because that's your contractual rights in there and the company's contractual obligations. So I'm just saying, a PUA, if I pay a PUA premium, and look, the charges are anywhere from 5 to 14% charge on the PUA. What do you think that's buying?
More death benefit. Yeah. Permanent death benefit.
No, it could be temporary. Well, if you never withdraw the PUA, right, yeah, the death benefit is permanent, and it is paid up.
Yeah.
Right, it's paid up additions, PUA. All right. So, but if I withdraw the PUA in the future, it's going to reduce my death benefit.
Yeah.
Okay, I still have more death benefit than I purchased or sought to purchase in the beginning, because that PUA premium has purchased dividends. And even the dividend at least buys one time the death benefit. What's the cost of that? So, and I'm bringing this up because it's always, in education, I don't care if you do the CFP, the life insurance, I don't care what kind of education you get in the financial world, the term is always reduced to the price of the death benefit.
Yeah.
The pure cost of death benefit. It's the least expensive.
So let me make sure I understand what you're saying.
Okay.
So we've got the price of, on the one hand, in the temporary term world, there's the price of the death benefit.
Yep.
And then you're saying over here in the world of permanent whole life insurance, even if we consider the idea of dividends going back into the policy as PUA premium, which buy additional death benefit. And even if we then assume that you later surrender that previously purchased death benefit, essentially reversing those prior PUA premium payment transactions, thereby causing the amount of death benefit that was purchased to be temporary, right? You had it from the time the dividend went to PUA up until when you surrendered.
And the PUA, additional PUA premium.
Right.
Because there's not a charge on the PUA if the dividend is paid. So if the dividend is paid to the PUA properly, there's not a charge on there. It's a lesser charge.
Yeah.
It compared to me paying a PUA premium in an existing policy.
Okay, but let me wrap this up. Okay, so you're saying that even in the whole life world, we got to consider that dividends are coming back into the policy in the form of PUA. That's buying more death benefit. And even if we assume in the future that those PUA premium transactions are going to be reversed, we could ostensibly then conclude intermediate that the amount of death benefit that those PUA premiums purchased was temporary in that whole life context. Yes. But during the time that it was on the policy, it caused greater dividends to be paid during that time. And there is a value to that.
Yes. And then compare the cost.
That's a really great point.
Thank you. And compare the cost of that. Is term really the most efficient way to buy death benefit? My answer is conclusively no. But your situation may be different. I get it.
Yeah, there's layers to that. So the first layer is that we're talking apples and oranges. One's temporary, one's permanent. Yes. So second, and then from a technical perspective, that means that one addresses estate planning and intergenerational capital transfer and one doesn't. Like, it's a meaningful distinction, right? And then there's the layer about, account for the fact that dividends buy PUA, and even in the event that we assume that PUA purchases are going to be reversed later, there's still a compounded effect due to the increased death benefit during the time that additional death benefit was left on the contract prior to the surrender. Yes. So there's value there too.
Yes.
And then third layer, there's also the fact that there is no charge. Typically there is no charge, no PUA expense charge, no administrative charge or fee when dividends go back into the policy in the form of PUA. So there's value there too.
Yeah.
And if you don't account for all three of those, then a quote unquote death benefit comparison is just illegitimate.
It's illegitimate, incomplete. And in addition to the cost of that, don't leave out the cost, right? So if and I get it that you may not have the contractual right to put in $1 million into the PUA, right? Mm-hmm. So, maybe you need more death benefit. And I'm not saying there's not a place for term. There is a place for term, in my opinion, even in the infinite banking world, okay? But you still compare the cost of the death benefit that the PUA purchased, compare that cost to going and buying a term policy, and maybe you go buy an increasing term. And there are a lot of term products are not available today that were in the past. You could buy at one time an increasing or decreasing term. I'm just saying the cost of that increased death benefit from PUA contributions and dividends, premiums to the PUA, and the cost of the term death benefit. There's a cost, and if you all life insurance is priced by cost per thousand, it's more efficient in a PUA. Then the cost is lower.
Yeah.
So,
and we're not even talking about banking yet. That's all just cost of death benefit.
But exactly. So, but if we practice banking, which everybody must jump over because it's more complicated than a two-step by the term invest a different solution. So pay cheap now for temporary coverage and give me your money and I'll invest it, dummy.
Through a government plan.
Of course, dummy.
Yeah.
Right. So I'm gonna talk about dumbing it down. It's so term invested different as opposed to, I don't know, let's think through this idea of capital. And you've done a great job over the last 5 years bringing capital in or enhancing Nelson's work on capital, and he talks about capital, jumps over. Okay. Two-step program by term invest the difference. Or I now have to take responsibility. I have to acknowledge that banking exists. We're all practicing banking, which is nothing but the movement of money, right? Loans, loan repayments, deposits in a bank, right? Withdrawals, life insurance company, premium, withdrawals or loans. So let's jump over the banking function because it's so simple to do a two-step, one and done, right? As opposed to, I've got to read a book. Yeah. You've got 100 hours of video on there, but I don't have time. Well, hell, I don't either. Right? Okay. And then it brings you face to face with a lot of things. Number one, who's performing the banking function? And most of us are not even taught the value of the banking function. We discover it going through life when the banker shows up and, assets are swapping because you couldn't perform their requirements, which... and I can go on and on about that. So it's simple, but it takes more time to understand or wrap your mind around and make that decision whether you want to implement this in your life. So, and then let's don't even talk about intergenerational planning because I've seen all kinds of statistics on term, how much as a percentage is term actually in force at natural mortality. It is dang near none. It's somewhere less than 3% down to 1%. I've seen all kinds of articles. How much of a term in general is paid at natural mortality? 97% of it is not paid out. Oh.
Yeah, I'd be surprised if the number was that low. I think it's more.
Lower.
Yeah.
I think so too.
Yeah.
But I don't want to be like the the commentator over there that knows nothing about their subject.
Sure. Well, that's a pretty informed opinion. It's not. We didn't watch a TikTok video and someone asserted it, so we're going to repeat it.
And I'll acquiesce here, but who goes to TikTok and makes a financial decision? If it's you, God bless you. Why would anybody? I mean, such a low-hanging fruit to target, right? Unlicensed, financial, non-financial people giving advice on TikTok, and you're going to make a financial decision based on that? Seriously? So who can't pick on that? Policy Genius. But then you're going to say that's where you're going to go find the IBC or the infinite banking concept as Nelson Nash properly designed, discovered, taught on TikTok? Yeah. And maybe there's some out there that exist. I mean, because I don't get on TikTok yet. I'll be there. But it won't be to give financial advice in a 30-second spot. Anyway.
One thing I've noticed is that just among the people that I know and interacted with, the idea that you're going to, and I think that in older generations this was not the case, but for people around my age, I just turned 30, but around my age.
Just like last week. Happy birthday.
Thank you. Around my age, the idea of an ongoing professional relationship with somebody who is specialized in their field, I don't think that really exists as a concept.
Really?
I really don't. Like the idea that you have an accountant and that's your person and that's who you go to for that service, or the idea that you might have an attorney, or the idea of a financial advisor, someone who's there on an ongoing, it's just part of your, I don't think that is as much of a feature of economic life for younger people. I think it's much more this idea of, compartmentalization, pick and choose, get a little bit from here, get a little bit from there. There's an inherent skepticism in the division of labor fundamentally. And so of course, let's go online. Let's go online. Let's go on to social media and let's get goldfish bite-sized clips of how to live life. And yeah, I think technology is a part of that because it's enabled that method of communication. And then of course you throw ads in there, and Joe Rogan did this thing recently where he read the terms of service on TikTok. They capture everything: your IP address, your device, your screen resolution, the titles of the files saved on your phone, the locations you go to, the other devices you use, what you do on those other devices, the other apps that you have downloaded, your keyboard keystrokes.
All right.
All of which is captured. All of that is then sold. And so it's profitable. In other words, there's now, it's not just the technology. It's not just that bandwidth is cheap and that data is easy. It's
data.
That there's a major profit motive behind it to fuel all of that. And so then I raised the question the last time. We talked about TikTok before. How many of those numbers are real? I don't know. But look, when a view means 30 seconds of watching, right? A view on our channel or on your channel of this episode, of an hour long, hour and a half long, that view, one view, is not the same thing as a view on TikTok. But we use the same word and it's denominated in the same numbers. Oh, a view there, a view here. They're fundamentally different. And at the end of the day, I mean, I'm sad for humanity that's the way people are learning about serious topics. But on the other side of it, it doesn't bother me one bit that so many people are distracting themselves with that. I mean, I'm sad for them because I don't think it's going to work out. You're not going to go, when you need service in 5 years, are you going to send a message to your advisor on TikTok?
Right.
Okay.
Yeah. Well, there's a couple of things there. So, all of your data exists in China, right?
Yeah.
Oh, well, it exists in the CIA or whatever too, because I'm sure all of that keystroke.
It's stored in multiple locations.
Exactly. Underground is secret location. So it's all big data. I mean, you're just a consumer, you know what I mean? And it's like, oh, let's don't even talk about the social credit and control in China. They need the data to be effective.
Yeah, to be effective prison wardens. Yeah.
Yeah, exactly. Ooh.
So that's Policy Genius. That wasn't all Policy Genius, but...
Well, we didn't sit down to talk about Policy Genius. I just couldn't help it. It's so entertaining.
Well, it's part of the broader thing of these hit pieces every now and then, always from the buy term and invest the difference people. There has to be this, I don't pick fights. I don't go out and look for this stuff. I don't go out and you got to tear apart this or that thing. I'm not interested. It's when the conflict is initiated, right? We got to characterize IBC. We're the third party independent people. Funny enough, in this article, not one Nelson Nash Institute authorized IBC practitioner was quoted.
Was the Institute even quoted?
No.
Did they mention Nelson's name?
They did.
Whoa, somebody can read.
But
they didn't.
Said something about that. I was surprised. I'm like, you got to recognize where real is real and where good is good. Like at least they mentioned the name Nelson Nash and the name Becoming Your Own Banker. Yeah. Which most of the TikTok people don't even do.
Nah. Well, this idea of service that you mentioned, you're going to call your TikTok professional or your Instagram professional or your Facebook professional or your YouTube professional for that matter.
Yeah. And the policies won't last.
Well, look, we get calls every day, daily, if not daily, multiple times a week, of people that have purchased policies or started down the track of becoming your own banker. And I'm not saying they made tragic mistakes. I'm not saying that at all. We get, weekly contact, emails, phone calls. Like, I've done this, but, it wasn't, I don't know what I thought I knew, and it's like, listen to your channel. It's like, would you look at this, or would you consider this, or should I, would you just, they know that what they're doing or what they have done is there's no relationship to what Nelson discovered, taught, and promoted, right? And two, when I say promoted, it is so not like promoting on TikTok or anywhere else. When Nelson printed his book in 2000, he stopped writing life insurance other than his family. All right. He had his clients that he took care of, but he didn't take on new clients. He stopped writing life insurance. So when I say promote, I'm not talking about promote in that sense. He promoted the idea that you could become your own banker at the you and me level. Right. So people continually call. Why? Because half the time they don't even understand they
don't know what they have.
They don't know what they have, and
how it compares to what's possible,
and how to best manage it, or what they should do or be aware of. If they do this, what's the result?
And some people, it genuinely and hopefully not, but likely permanently sidelines them. We've talked about Jared before, who couldn't get over the fact that his IUL policies illustrate at 6% annual every year, and that he's going to have all this passive cash flow late in life when his mortality cost is through the roof because his age is so high. Could not get over that. After 4 weeks worth of calls that I just donated to the black hole of time. So it really, it actually distracts and sidelines people.
It does.
Especially the ones who have done well, and for all intents and purposes, rightly so, have developed a degree of competence and also confidence in their decision-making ability. And if that marketing bait tastes good enough, they stick around and they'll swim in that pond. And that's unfortunate. It's really unfortunate.
The IUL as a whole, literally, we could run a podcast on the IUL.
Yeah, I don't really want to. But.
No, I don't either. When you get the basics and the fundamentals and of how IUL works in any flavor, IUL is index, but index universal life, variable universal life. When you understand what goes on there, and most agents do not. And I know I'm painting with a broad brush, but I like to say, as you said many times, the canvas is big. There's a big canvas.
Got a lot of canvas to cover. Get out the roller.
But when you see and understand that the cost of the insurance continually goes up, and there's nothing that you can do about that except for the only thing you can do is increase the premium and or reduce the death benefit. And I'm surprised that they only look at or use 6%. That you could use multipliers in a universal life and illustrate higher rates of return than that. Yeah. And those are net rates of return too that they typically illustrate. We can go on, but but whole life is just such a small rate or small. I could do so much better anywhere else. Blah 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 blah.
Yeah. In contrast to all of that nonsense was a recent interview you did with Jerry and Becky. I forget their last names. Did they give their last names? Stringer.
Yeah. They're public people and great. I love them.
That was great. There were a few things I wanted to say about that. So I'll bring up the episode number so I can tell people what it is. They can go look at it. But it was very recent. Here we are in July of 2022. Let's see how fast I am. Oh, wow. I've got it. There you go. Your name. Okay. Episode 137. I don't love the title, but that's okay. But in fact, so the title.
What is the title?
The title is Real Estate Flipping and Owner Financing with IBC. fine.
I chose the title. And look,
I know, but let me say this because you'll see why I don't know about it.
Did you say 137?
137.
Okay.
Yeah, episode 137. So Becky has been a real estate agent, is now a real estate broker. And so one thing that they use their policy for, they take policy loans to go and buy the mortgage notes from the banker on their real estate properties, which brilliant, great, love it. But as soon as you hang something out, like real estate investing,
I know,
like and I loved where you went with this, but I don't know that people picked up on it. That's why I want to highlight it. Is that you said that's something you know about, and so what was important about that is not that you could take policy loans to go buy the debt on real estate. Yeah. What was important about it was that she could take policy loans, they could take policy loans to go be active in something they knew about.
Yep.
And that happened to be real estate because she happens to be an agent and now a broker since 1985. So she probably knows something about real estate. But you also mentioned firearms because Jerry was big into guns. He even said at one time, he's like, well, I'm not flipping guns. I'm just a buyer. And he's like, I don't want the mandated federal insurance to be a dealer. And so but I like that you brought that up because like, it's not just real estate. And the firearm example is a great contrast because of course you can't legally do it. I get it. You got to have all the freaking licenses and whatnot, but it's something so unusual that people don't normally think of that he happened to know something about.
He's going to do it anyway.
Right.
He's doing it.
Well, and another example was the laser engraving.
Oh yeah. Thanks for going there.
That he did. That's an attainable thing, right? You could buy a piece of equipment that ordinary people would never buy, but that there are hobby people, enthusiast people, the kinds of tools and equipment that you would never ordinarily buy because the price has 5 digits to it or 6 digits to it that you would never ordinarily buy now becomes a possibility. And how many times you go sit down with the Big Four financial advisor person who talks you through how to go buy equipment in the thing that you care about, that you know about, that you hadn't even told the advisor about because you don't think it's a financial thing. You don't think it's an investment type thing. You don't think it's an entrepreneurial thing to be discussing with the financial advisor. How often does that come up? Oh, never? Okay. But suddenly it's on the table for somebody who has access to capital. And, we always talk about Nelson, and in particular, this idea that capital attracts opportunity. There's a sense in which, that is fundamentally true, but that word attract, I think in my mind at least, maybe other people are different. In my mind at least, the word attract kind of seems fleeting. Like if you're attracted to a person, you might see him and like, oh, feel an attraction. And then maybe they walk off or go away and it's like, oh, that's gone. There's a temporality, like a fleeting nature to this idea of attraction, whereas it's really like a magnetism. It's like, have capital will have opportunity, and it's stronger. It's got to be stated stronger than just attraction, although attraction is correct. And that laser thing is exactly it. And how many people, Nelson, again, all things in finance are relative. How many people are in that position?
Yeah.
Where your competition, the word competition, where competition is most intense is where people are the least capitalized. Because everybody's fishing in the same pond. Everybody's fighting in the same pen. But if you differentiate yourself by being well capitalized, throw in there a little bit of, God granted individual unique talent and ability, you're a party of one. What competition,
It's all between your ears.
Yeah.
It is. I'm glad you brought that up because Jerry is very conservative, right? We could have gone much further, and we can with all the guests that come, in, take their time to come in. And this is a hobby that he's had, and he's very good at it. He makes makes all kinds of things, the Texas Ranger presentation, retirement boxes. This guy's very, very talented, right? And so he has a lot of, repeat customers, right? he was telling me, and I think he even brought it up on the episode, that he's got so much work he turns it down because he retired. He's like, I don't want to hire anybody, and I don't want to be 12 hours in the shop running that laser. So, you know, your comments on magnetism and attraction, it's like the attraction isn't fleeting, right? I know the word, it's continual.
Yeah.
It's continual
and
attraction.
Growing.
Yeah. Various opportunities. I've said, and I believe because it's true, when you practice the infinite banking concept, your ability to even recognize an opportunity increases. It's a skill, right? Because everything walking down the street is not an opportunity. And whenever you have capital and you're not dependent upon someone else's capital, then, you know, triggering all the I'm without, or I'm less than, or, you know, I can't do it because of this, all of that goes away or lessens. I have capital. Now, I'm not every deal, you know, I'm not pressured. I don't feel self-pressure to go get a deal just to be in real estate or whatever it is. And so your ability to spot and recognize an opportunity absolutely increases in my experience. That reminds me, you know, Jake just had a birthday, right? When he was small, he had he liked RVs, right? He's a kid, you know, 5, 6, 7, 8, 9. And so when the RV show would come to town, we would go to the RV show because he loved RVs. And we're walking through these things. And I remember the first time Jen and I went with him, and the price tag on all of these things. And then there's, you know, oh, this one's just tin and stick, or stick and tin. That listen to the salespeople talk about each other and their product. It was all fabulous, right? But I'm like, man, I really want one of these. It's like, oh, this is what I want. I don't RV yet, right? We didn't have a place to park. We couldn't afford it.
Yeah.
No question. I mean, you know, maybe could have got financing, maybe. Anyway, we go, you know, several years later, we've gone several times. And then when you can walk in there and just write a check for one, it's like the desire to have one is gone. I'll rent one. Thank you. I don't need one. You know, I mean, but that's all between the ears. I can't have that. Well, that's exactly what I want. Oh, I can have whatever that is. And
your degree of access to capital transformed your preferences for that particular thing.
Yeah, and my internal thought process of, you know, I can't, I'm separated from, I'm less than, you know, you're telling me this is going to solve all my problems, RV or whatever it is, and all the joy that it's going to bring.
Yeah.
Okay, well, what an escapism going through that thought process. But the mere fact that you can't go get it, you know, is like, just tell a child they can't have something and then ask them what they want. Right? That was a profound moment for me. It was a growing, learning.
That is profound.
I'm like,
I've gone through that very recently.
Oh yeah. So
you think you want something, and then come to find out you can have it if you want, and it's like, well, do I really want it? Like, or was it just, you know, daydreaming?
A meat sweat moment.
Yeah. Yeah.
I'm saying meat sweats because we went out last night and ate a bunch of steak. I didn't get the meat sweats, but I tried. Right.
No, that's real. But then, okay, so other things that came up, I like how Becky directly mentioned the discomfort level with the idea of life insurance, how was a hurdle, and then how she had to get over that. Yeah. I was very honest, and that was cool.
I didn't know if I was aware, you know, it didn't come to mind that Jerry had participated in A.O. Williams.
I didn't know that either.
I didn't know. If I did know, like, I just didn't think about it.
A.O. Williams was in the 80s the largest seller by volume of insurance for multiple consecutive years. And they profited off of the 1979 FEC report. Yep. That blasted dividend-paying whole life, and made a whole business off of replacing permanent dividend-paying whole life with term, and partnered with mutual fund companies to sell the high-load mutual funds, and made eventually sold out to Primerica, and A.O. Williams is still alive, a billionaire. They're probably the reason why we have that term, buy term and invest the difference.
No, he got it from a Fortune 500 company that he worked for.
I mean, the reason it's so prominent, like they were such amplified that message so much across the country. I didn't know that was weird.
Yeah, now Prime America, Barry Dyke, in I think his second book, just goes through it cites the holdings, the life insurance holdings, permanent life insurance holdings of corporations, and you'd be surprised how much dividend-paying whole life insurance Prime America owns. But they want their consumers to buy term. Wonder why? I've said it many times. I don't know. I do know which is most profitable to the life insurance company out of three products. Is it term insurance? Is it universal life? Or is it dividend-paying whole life? Well, a mutual company is the one that pays the dividend, typically, right? They're owned by the policyholders. And I'm not married to the life insurance companies, but it's less profitable up front in the short term compared to term insurance and universal life. Which one is more profitable? I suspect that it's term insurance, but they're both very, very profitable. So that makes sense then why Prime America gets their people to buy term.
Yeah.
It's all profits.
This is from federalreserve.gov, the Board of Governors of the Federal Reserve System. They're under careers, under pension plan. Most employees are eligible to participate in the Federal Reserve Retirement Plan, the board's pension plan. And it is a pension, a defined benefit, not a defined contribution like a tax qualified plan that they want everybody else to participate in. After completing 5 years of service. What a careful use of language. You are vested and entitled to a monthly retirement benefit that can begin as early as age 55. Hey, by the way, what happens if you draw from a tax qualified defined contribution plan before the age of 59 and a half? Oh, are you penalized for that? Okay, but the Fed board member or the Fed employees, they can start drawing at 55, penalty free, guaranteed.
No, I'm sure they're financially secure and, no problems, but their pension is guaranteed by the PBGC.
Pension Buyers Pension something Guarantee Association.
Yeah.
I think it's Pension Buyer. We're going to look it up.
Okay. Well, I have recorded an episode.
Pension Benefit Guarantee Corporation. Pension Benefit Guarantee Corporation.
So they insure, quote unquote, pensions, like the FDIC, quote unquote, insures, deposits at a bank, like the guarantee associations are secondary, guarantee to life insurance and annuity products, right? Okay. All right. So I have it's not out yet, but recorded a friend, Paul Horsley. He was an airplane driver. Right, big company goes, merges, goes bankrupt, and that was part of his awakening. He's about ready to retire. Oh, and the PBGC comes in and guarantees a part of their pension that they're all working for. Right. I'm not saying that's the only reason why they work, but it's a big part. Yeah, that can never happen over here at the Federal Reserve because they'll just create digits or whatever. Right?
They'll just print the money. Yeah. Half of all PhD economists work for the Fed. Half.
What's wrong with them? That's a legitimate
How much
question.
time do we have?
Oh, another episode, huh?
My point is that the people in charge are looking after themselves with permanent products. And Barry Dyke often refers to this in his books, and they're all funded by annuities, which
life insurance companies.
Type of life insurance, yeah. A whole life policy offers the same kind of permanency, the same kind of guaranteed elements, and more. The policy loan provision, the non-forfeiture options, the superior tax treatment.
Well, the cash balance plans, you can bring a cash balance plan into a 401k, and then part of the cash balance contribution can be life insurance, very limited, can't use PUA or very limited PUA, and the other half has to be an annuity, blah, blah, blah. It's about guarantees. And then, of course, that has a tax deduction component, which is, when you go to the CPA and he says, hey, I'll get you a 30%, they'll say, I'll get you a 30% rate of return. They're talking about a tax deduction, which is a whole nother, just not apples to apples kind of thing. But if I have a lot of cash value in life insurance policies or life insurance policies, can I annuitize that cash value for a guaranteed income for pick the time period? Yeah.
Whenever I want.
Yeah. I mean, you may be limited, right? Because the cash value is cash value. And as you're withdrawing it or what have you, I mean, it's going to go down to zero. So, I mean, it just doesn't take that much management. It's like, okay, here, life insurance company, how much income can I have to age 99 or 98? What's guaranteed? What's not guaranteed?
It's like Nelson always used to say, and I do this with people when we get to the illustration review portion of the advisory process. This is third grade math. I do. It's very simple. Let's assume you start drawing money at 70. Let's assume you die at 100. That's 30 years. Let's look at what that annual cash value growth is at around 70. Let's look at what that annual cash value growth looks like out in the future. I get it. Illustrations are based on the current experience of the company. Dividends will change. The numbers won't be exact.
All right.
But the main contributing factor behind that number is your premium payment.
That's right.
So it's going to be in the ballpark. It's going to be a heck of a lot closer than that made up number on the tax qualified plan investment prospectus, right? That we just plucked from thin air, right? Totally arbitrary. This isn't arbitrary. This is very specific. Current experience of the company, time, your premium payment, well-run mutual company. Not arbitrary, very specific as we can get. To have any more accurate foresight, we'd have to be God. We'd have to know exactly how things are going to plan out. We're not there, but we can get pretty close. And so let's take what's the cash value? Well, at 100, let's divide by 30. It's not, people come away with this idea, and it's often because, and I have a story related to this, it is often because, and this is not a digging at the advisory world, but it is often because the advisors themselves do not understand the product. And I have a client, John. Hi, John.
Thanks for listening, John.
Yeah, whose wife, for various reasons, had an unfavorable offer from a more preferred IBC friendly company, but she had received, previous to engaging with me, she had received an offer from one of the big four who have more lenient underwriting processes because they're fleecing other people with their financial services products. So they don't need to have superior selection. So they made an offer somehow. Even the underwriter at the company that provided the unfavorable offer, he's like, yeah, she should take that because we're not moving. Yeah. And they move. Like if I ask them and there's greater scrutiny, and they'll make exceptions if appropriate, but he's like, yeah, no. Yeah. And understandably so, given her background, which I won't say here, but anyway, so they had an offer on the table at this other company, which they had not yet accepted, but they had neither rejected it. So it was still available if they wanted it. And so I told John, I'm like, look, it's not, that policy is fine as it is. It's whole life policy. It was I won't get too much into how the design of it came about, but it essentially a base only dividend paying whole life policy. And then they added a blended term PUA rider onto the policy. And so there was the ability to generate some cash value. But to my mind, I'm like, well, look, you've already submitted the application. Theoretically, we could ask for the company to make changes and maybe we can improve it. Maybe the advisor who is
before it's issued.
Right. And even if that requires, their underwriters to go back and look at it, so be it. Put them to work. I mean, so I'm like, what I told John, which I will not ever do again, is, look, I don't want anything.
I hear a learning lesson coming on.
Oh yeah. I told John, I'm like, I'd be happy to talk with that advisor and just. I don't want nothing. I don't want to be on an app. I don't want to check. I'll just talk to him and see, does that particular company offer the necessary elements that I would consider to be superior to what's on that policy right now?
Well, that advisor's already out when you use the word superior to their work.
Well, I didn't. James, it was an ear beating.
I'm sure.
I mean, it was just from go on this video call. about 5 minutes in, I'm on the video screen, so I can't really react like I normally would, but it was just, he had to defend what he did, and I wasn't even picking on him.
Self-defense, justifying. I bet he's like, making sure the client agrees with whatever he did and whatever they justified. And, I told you, and then he probably tries to put some kind of an onus onto the client, whether we covered it, but
we met 12 times. 12 times. We probably spent 20, 30 hours. Jesus. God bless you. And now here I am facilitating the sale. And he's mad at me.
Yeah, of course.
I was blown away. But then as he's going through, the language is so revealing. One of my questions was, well, does this company offer a long-dated level term rider instead of an annual renewing blended? And he's like, well, the dividend could go to purchase 1 year term, but it's on the PUA right now. And
justification.
We put the dividend to the PUA. I didn't ask about the dividend option.
You didn't ask about the PUA either.
I didn't ask about any of that. I asked about the availability of term riders. And he shared a screen, and so I can see on the screen that there's a 20-year term rider.
Oh, okay.
But I asked him the question, and he's an inch down, poking around at the dividend. I'm like, no. Can we do the term rider? The long-dated level term rider. All I wanted to know is, can we have long-dated level term instead? And then can the policy owner pay PUA for longer? Because, and I had to tell him this, like, I don't know if you know this, but like with a blended term PUA product, you're not going to get as many years of PUA as you otherwise could had there been long-dated level term. He goes, oh, well, that's never happened. We've always been able to pay PUA with long-dated. In 100 and some odd years of the company's history, people have always been able to pay that. Because the blended term, the blended PUA term rider, the premium for that never goes up. Right? We've never had a premium go up on that in all our 100 and some odd years of existence. And I'm like, sir, I understand that the premium's not gone up because the rider falls off the contract before the individual insured gets too old. He's like, well, that's never happened. Okay. All right. At that point, it's like I could rather watch paint dry. I mean, this would be more productive. So I was so come to find out that this big four company, big, strong company, doesn't even allow, and I did not know this ahead of time, had to take this ear beating to find out, that big four company does not allow with their version of PUA payment if you use anything other than that blended term PUA rider. You have to use the blended version. If you put long dated level term, you could do that, but there's not going to be any PUA. And that was like eye-opening. He even tried it. He clicked the term thing. He tried to input their version of PUA and click generate, and the system generated error codes. You cannot have PUA without
did you screenshot that?
No, I didn't.
Dang it.
Dang. I didn't.
Yeah. See, it was a learning lesson.
Yeah, on multiple levels.
Well.
Yeah, at the end of it, I told John, I'm like, look, and he knew, because he knows how I watches the podcast. Yeah. And I'm like, look, I try to be nice to the guy. I don't want to hurt. I'm not trying to step on toes. I really wasn't. Like, I really just wanted them to end up with a superior banking-oriented policy. Yeah. I'm like, look, you might be able to go see, can you have no term and pay some PUA, maybe with a structure where more of the total premium goes to the base. Maybe he actually raised that. I'm like, well, yeah, maybe you can do it. I don't know. We didn't ask. But if you want to keep asking him, God bless you. I don't want to be involved, but you could leave
me off that call.
Yeah, you could take delivery of what was offered as it is right now with the blended term, and it's not ideal, and he knows, and there's still cash value, and it's still going to look good, just like a 90-10 does, and all that. It's not going to be as good as it could have been, but that's fine. It's still something.
But she has something. She's insurable, right? If you're highly rated, and I'm not going into a deep discussion there, but look. Uninsurability generally happens suddenly. All right, look, I'm 59. I was thinking about that the other day, floating around in my pool, enjoying the traffic, watching the traffic go by in my pool.
Yeah, one car every 3 hours.
And I'm like, wow, it just dawned on me. I just turned 59. I'm not quite there. I'm a few months away from being able to rate all of my qualified retirement plans without a penalty. It's dang it. It's like, it happens. I'm just saying we age, right? When I'm young, I don't think I'm going to hit 30 or 50. My point here is the becoming uninsurable generally happens suddenly. I mean, it might be a slow decline, and then you're uninsurable.
Yeah.
Right. And so
slowly over time, and then all at once.
Exactly. And so if someone's insurable, and I appreciate you doing the right thing. We have the discussion all the time here, everywhere. It's like people can talk about illustrations. They can talk about this. They can talk about that. They can talk about replacement. They can talk about manipulating. It's like, listen, what is correct? What is the best for the client? And anything that deviates from that is wrong. Period. So her being rated, I haven't looked at the case. I don't know all the details, but if you're rated, it's probably a good idea to take the rating and then work on dropping the rating if it's possible. And that policy on her sounds to me like it's just one of multiple policies. So they are building a banking system.
Building a system.
All right. I mean, I was talking about this the other day too with an agent that work with and mentor, and we're talking about, well, direct or non-direct recognition. This is direct, this is non-direct. And I get it. It is what it is. But what's the best interest in the client? I mean, I've got non-direct policies. I mean, direct recognition policies that are 16 and 18 years old. The company doesn't even pay a dividend anyway, right? And I assure you, and I'll bring that up.
Paid the premium,
yeah, they're like, well, why don't you 1035 exchange, or why don't you reduce paid up? I'm like, what you cannot put on this illustration is all the automobiles, the vacations, the dental expense. We don't have dental insurance, so it's not like it's a health insurance deductible and there's no place to put all that on the life insurance illustration. And those,
they weren't going to pay a dividend anyway.
Well, I didn't know that at the time, right? Because they all come around, oh, we love the infinite banking concept. Yeah, we know who Nelson Nash is, and yeah.
This guy said the same thing. Oh, I've got his book.
Of course. See, I've got it right back there. I haven't read it, and and I'm like, but I mean, those policies are a part of a larger. Why do I want to go through underwriting again? Well, because I want more policies, but I'm not going to go through underwriting just to replace those policies,
Restart that whole compounded growth curve. Yeah.
And I don't care if it's 16, 18 years for me. Those are the first ones. I mean, I'm just saying that not all policies look alike. But do you think I care now? I do not care.
Yeah. I tell my story about this to clients. I don't know if I've mentioned it here before, but I got after I met Nelson in May of 2016. Was it January? It was early May, because my policy date for the policy, I went and got a policy immediately after.
Typical, it's like, I heard Nelson Nash, so I'm going to go get a policy because it's good. But then
it's easy, right? All I got to do is buy insurance.
Right.
Yeah. Okay. So this little mangled novelty policy.
Very, very good life insurance company.
Great life insurance company.
One of the oldest in the country.
Yeah. Horrible design. I didn't know what I was doing, and neither did the agent. God bless her. She's a nice woman, but it just... Anyway, so the premium was too low. Even then, even when I was working part-time, 3 nights a week at a restaurant, full-time student, the premium was still too low. Yeah. The idea of term on the term rider, or the idea that PUA premium, the amount of PUA I could pay might change in the future. That wasn't even a concept to me. I'm like, well, if I have this, I built it. I didn't build it. I told her I want what is in this book, part 4, equipment financing. It's a 37.5, 62.5 structure. I want 37.5% of my annual premium to go to base, and I want 62.5% to go to PUA, because that's what Nelson did.
16 years after that book was published. 2 CSO table changes.
It's so bad.
Yeah. We can go on and on.
It's so bad.
But does she have to read the book and study that illustration to do that?
Oh, no.
Or does she just take it up to her, managing GA and say, hey, can you build this?
Yeah.
I don't know.
That's exactly what happened.
Oh.
Yeah, that's exactly what happened. And I went later to work for this company for a bit, and that's exactly what they teach you to do. Just the client says so, you want, then give it to them, you know. Yeah. Don't look a gift horse in the mouth kind of thing. And so she's like, oh, yeah, we can do that. The maximum PUA on that policy that I wanted was payable for the first year, and then it's declined.
I explained to him, and I continue, it's like, I explained why he wouldn't and why he shouldn't. But I did make an offer, and it's a standing offer. I'll buy the policy. Yeah. It's like with Nelson, you know, when he writes about his silver experience and how, building a warehouse of wealth. I'm like, it was a standing offer because he bought silver at like almost the peak at 40. It went to like 49 or 50. And I just couldn't help it every time. I'm like, Nelson, you want to sell that silver? Yeah. I'm still a buyer, you know. It's like, I'll even pay, you know, when silver dropped below his purchase price, you know, I'm like, I'll pay you what you paid. And I'll give you your money back, you know, because wherever you bought it, they probably have a buyback guarantee anyway. I'll even make higher offer than that. Just to jack with him, you know.
Yeah. So, but you know, have I replaced it? No. Will I? No. Do I continue to pay the little tiny premium? Yes. And I'll continue to. And it could have been a lot better, but there's cash value there.
Yeah, and you can RPU it, you know, and you can like 1035 exchange it and all that.
About 100, and it's going to get paid every year between now and then.
Yeah, I'm bringing that up because just in general, you know, some of these people that call almost to the person regularly every week, as I mentioned earlier, you know, I've done this. What should I do? You know, should I 1035 exchange it? Which is what they hear very often. Oh, let's get rid of that, and you know, and we'll build you this. And it's like that's not always the case. It's like some of these schmucks out here, the agents, not you, the lovely listener. Let me see. I got nothing but love. Okay. You know, I've had clients call about the 6th, 7th year, and it's like, you know, I think I'm gonna, you know, I want to do something different. Or you get the replacement notice, you know, which by law you're supposed to, you know, have if you're going to replace a policy. But I don't know what agents do, and I don't know why they do it half the time. Anyway, it doesn't happen very often, but when it does, invariably, they've, you know, clicked on something, they're drugged down these rabbit holes, and you got some guy out there trying to shred a 5, 6, 7, 8, 9-year-old policy to replace with a new policy.
Some of the stories you've told me about experiences you've had or clients of yours that have had that experience, I'm like blown away.
Why? You know, and they innately know. I mean, I've gained a lot of clients because it's like, no, here, look at what you have. This is what it's doing. This is what it is. You know, and
keep it, pay the premium.
Yeah.
What, you know, manage it.
Yeah. I mean, if it's worth replacing, yeah, by all means replace it, but don't do it uninformed. Yeah. Right. But when you have a dividend paying life insurance, I mean, you're pretty hard pressed I'm very hard pressed to replace it. It is never where you start, in my opinion. But, you know, they create the marketers create these great big, you know, Excel spreadsheets or whatever. And I'm sure there's software out there in the industry to shred each other's, the life insurance company's products or whatever.
Probably the same company selling the software to the two different competitors.
You think? Yeah, and getting them all dependent upon that third-party software, right? And then they want to promote it to you, the consumer, the client, so you can be dependent upon it. And it's like, that's the opposite of what the infinite banking concept is. That's the opposite of becoming your own banker, is to be independent, not dependent. So,
going back to Becky and Jerry, you know, she mentioned the dividend thing. The more time has come on, so what really surprised me, which is, looking back, it shouldn't have, but she had been a real estate agent for quite some time. Mm-hmm. And then come to find out that APR thing on the mortgage has nothing to do with the actual interest rate that we consider, what people think of when they hear the word interest rate, you know, percentage of the principal paid to the lender is what people think as an interest rate. Or if you invest money, the percentage of what you invested that you receive would be your interest income. Like that. That's what people think of when they think of interest, and appropriately so, right? That's a perfectly economically coherent understanding. That has nothing to do with APR. And one day I'm going to do just self-inflicted punishment study of that.
That's what it is.
1972 or 3 Truth in Lending Act, where APR came about. Sometimes I see on social media, there's this one congresswoman, I don't know where she's from, but she's one of these alleged consumer advocate people who was a CPA or whatever and wrote the textbooks and explained how to do APR. And there's like these gotcha videos online where she's criticizing a Biden administration official who doesn't know how to calculate APR. And they think that, she can't calculate APR. I'm like, who cares? Can you, Congresswoman, calculate the dang interest rate? Oh, what's that? Yeah. Total blank out. And
I have to ask my assistant.
Yeah. And I it's so easy to do this. It's just so different, right? I don't like making up terms, but I just refer to the true cost of interest, right? The true cost of borrowing money, right? The actual, what Nelson would say is the interest rate by volume, right? The amount of your payments, the amount of the principal, the amount of what you borrowed that goes to the lender in interest, right? A genuine interest rate. How do you calculate that? Take your dang payment, take the monthly payment, calculate the total amount of payments. So if it's a monthly payment for 30 years, take the monthly payment, multiply by 12, then multiply by 30. There's your total payments, right? Back out the amount the amount borrowed. Get the actual amount you borrowed. Take that amount. Back that out of your total payments. The difference between your total payments and what you borrowed is the volume of interest. Take the volume of interest. Divide that into the principal. There is your true interest cost by volume, your true interest, the true cost of borrowing. That number is a double-digit number that's a hell of a lot bigger than the APR. And that is the meaningful number.
Yeah, there's...
And it can be done with any asset, any type of debt. It can be done with any type. Yeah. It can be done with the mortgage. It can be done with the auto note. Any structured debt instrument where you can determine the total number of payments, and you can back out the cash price of the item, whatever it is, allows you to isolate the interest by volume, the amount of payments that went to the lender that did not go to the principal. You can identify that number so long as you know the term of the loan. By the way, the unstructured notes, the ones that don't have a specified duration, are even worse. Okay? So it's not like, it's special because it's a line of credit. No, it's just even worse, right? There's monthly compounding and, just wait. In fact, they'll gladly take that open line of credit and transition it into an amortized note so they can bleed you dry while it's unstructured and then start the process over again.
Wait. You have a line of credit if they call it, right? If they cap it, you have a $100,000 line of credit, but your balance is 50. Oh, that's your new limit. Oh, wait. And then they can forget the last Wells Fargo is the last one 6 or 7 months ago that called all their lines of credit for small businesses. They called them. Okay. They called them. They called them, right? It's like, yeah. And then, wait, you don't have it? Of course they'll convert it to a time note. Of course. That is the process of a lender. You've got to, oh, wait, and I know you're the only one out there that has a non-recourse loan, right? I don't want to beat people up. I know they exist, but me and you don't have them.
Yeah.
All right. It's like that is part of their program. If you can't pay, we'll convert it. No problem. If you can't pay the conversion, we'll just take your assets. Right. And what lender is gonna under collateralize a loan? None. Okay. So rate versus volume. That's a great, simple, we should timestamp that because that very simple, right? And Nelson used to say, and this is how I, filtered it through me and my experience, if I have a cow, she weighs 1,000 pounds and she's sick and I got to doctor her, does it matter how fast I give it to her, right? The rate,
medicine, yeah.
Or how much I give it to her, the volume. Too little does nothing. I might as well pee on my dog's head kind of a deal, right? Too much could kill her. It's the volume. That's exactly what Becky front and center when they were buying the property and going through those amortization tables. Oh my gosh, I need to be financing.
And she was an agent for how many years?
I don't know how many before she discovered that, but I don't know.
But it's nothing against her. It's just that it's concealed.
Yeah, but exactly. She's in the industry, the noise, the construct. It's all concealed. Don't look at that. Look, it's 3%.
Look at that low number. Look, I can do it on my hand.
Yeah, so why would you ever look? Or if you do look at it, when you close, they got to give you all that if you're borrowing their money, and you're like, oh my gosh, that's a lot. I'm gonna pay it off early. But that I think we left something out on the true cost because you didn't bring up closing cost.
Oh yeah, just add that back.
Yeah,
add that in there. Don't forget, they call interest. It goes by many names, right?
Yeah.
They're happy to call, the points or origination.
The PMI that's required. It's an additional cost.
Administrative fee, paperwork fee.
Closing doc, Yeah. Oh,
lawyer fee.
Yeah.
Filing fee.
Yeah.
All that.
Everybody's getting paid.
Yeah. It's the cost of borrowing. Yeah. And the cost of borrowing is interest, no matter what name brand they stick over the top of it. Yeah.
And then let's go refi every 4 or 5 years, right?
And just start that cycle
it's
over
perpetual. Again. Well, let's just go buy a life insurance policy and practice the infinite banking concept that I got to buy a new one every 4 or 5 years because somebody's looking at the equipment finance illustration and they see clearly because there's nothing concealed or Nelson's trying to enlighten you what's going on. And I'm not condescending the listeners. I'm talking to the agents like you're one agent that's like, yeah, we can do that. Yeah. 4 years of premium. It happened to be, 60-40 or 67-72 or
the structure of this big fork.
No, the Nelson. It's 60-40.
Oh, equipment financing, 37.5, 62.5.
Yeah. So that's and of course we round it. I love rounding numbers too. But that's why that's where this idea of everything should be 60-40 comes from. Yeah. Is from Nelson's equipment financing example, which is different from all the other and different products.
Why not Susie Q?
Exactly.
That's the 30-70.
Yeah. I talked about these exactly in the last Think Tank presentation that I'm going to develop that out because people need to hear it, and they already suspect it. I'm just saying that, and they look at that and say, oh, this is the way you do it. Well, I can make the illustration look better if I go down to 10% to the base and 90% to the PUA. And Nelson only paid 4 years of premium, and he went cash on cash, quote unquote, on the 4th year. So I want to reconstruct that here in 2020, 2021, 2022. 2 CSO table changes plus the 7702. Dividends have come down because interest has come down. All of these changes are not considered. Right?
No.
They're just trying to match that work.
Nor the fact that becoming your own banker is not how you go become your own banker. It's unlocking the infinite banking concept. It's teaching a concept. It's not, hey, you should go out and literally start a grocery business. Right? That wasn't the point. The point wasn't to go get a charter from the state of Texas to go compete with Midland National. Right? They're all illustrative. They're all examples. They're meant to illuminate, to explain a concept, not to say, hey, this is how you in particular should do it.
Exactly.
So you got to jump over that, and then you got to jump over the timeline thing, how things have changed. Yeah. Rather than dig deeper, look at the concept and say, oh, well, gosh, if it's good to pay a premium today, might I want to pay one in 30 years?
Which is exactly what happened in equipment finances. Illustration number 2, 3, 4, 5, 6 should be compared to number 2, where you compare that with the 90-10 structure, whatever, these blended PUAs or whatever, that you're limited on your premium payment ability. So it's exactly what not to do, but they're looking at Nelson's work and saying, this is what you do. And 2, it's not really a concern, but it's an awareness that I have that. And it's why I don't mention life insurance companies' names. You do not start building a policy from the perspective of a percentage of premium between the base and the PUA. We can all calculate that after the proper solution is created, right? And that comes from an educated consumer and an educated agent and advisor. But, if you mention a life insurance company name, my concern is like, oh, well, that's who we have to use. Or you mention a structure, oh, well, that's what we got to do. No, you look at Nelson's book that, you got to go cash on cash in 4 years, anything else. And I've seen these these private Facebook groups or whatever that have the conversations between quote unquote agents, like, if it's any other way, it's wrong. It's like, my God, man. My gosh.
Yeah. I learned how to do it right. Mm-hmm. Reminds me of the Pharisees.
What?
Yeah.
Yeah.
So
it reminds me of the money changer.
Mm-hmm. I mean, because another part of this too is that, we hear about, okay, I'm paying premium, building cash value. I just had a call with with an interesting person yesterday that I texted you about. Wanted a Zoom call. A phone call. Yeah.
I have a question, so I demand your response.
Yeah.
And
how do I use this, Ryan? What should I be using? I feel like I'm not doing this. What are you not telling me? I mean, just so I'm real close to just swiping left, but
you made a commitment to them. Sorry, and then
and I'll continue to service it. Anyway,
well, you could call an agent and spend the same amount of time with an agent and see which one's more pleasant.
That would be really fun. That's how I want to spend the day. Yeah. But okay, this broader question of, I'm paying a premium, I'm building cash value. What do I use it for?
Yeah.
If people, and we you think it's in Nelson, it's a slogan, it's a main talking point in IBC. It's not about the rate, it's about the volume. But somehow we always end up coming back to the rates. It's like a person with Stockholm syndrome, just can't take a beating enough. We got to come back to the rate, back to the rate, back to the rate. And I'm starting to wear on me a little bit, and I got to relax and understand. But if people really understood how expensive a mortgage is, what it would take in terms of premium payment to generate sufficient cash value, to take sufficient policy loans, to kill the mortgage as early as possible, that in and of itself is enough to do. Like, how about we do that first? How about we start at home? How about we literally on more than one level start at home? How about we do the mundane, boring, unsexy stuff first? How about we clean house first? Like, Jordan Peterson, just go clean your damn room. You don't need to go out and solve the world's problems, or get the state to foist upon the new eco-friendly generation for the next for our children and their children after them. How about just go make your bed? How about just clean house yourself? Okay, how about we take care of the auto note? How about we take care of the auto note? Because I don't know about your family, how many automobiles are in your family? You, your spouse, your children, their spouse, over and over. So I get it. The most egregious loss of interest is in a mortgage. But even Nelson, it's like, that's really not the place to start. It's not, because the number's too big.
It is. It's hard to wrap your mind around. And it's like, what do I got to do? So
look, the auto loan's a bad offender too.
Oh my!
So it's okay to knock him out on the way to the mortgage.
Look at the experience you'll get of, just the interaction, the application of your policies.
Yeah.
Right.
And I get it. Look, some people might be out there and they may have conventional debt outstanding, and this opportunity from heaven may have just fell right in their lap. And, that cash value is either going to be deployed as a policy loan to go take advantage of this once in a lifetime opportunity, allegedly, ostensibly, or, we could pay off the conventional debt, which is just so boring.
Look, Bitcoin's down.
Okay. Yeah. I know. Yeah. That could all happen. Okay. All right. That might happen once. Maybe it'll happen twice. Maybe it'll happen 3 times. I don't know. But your ongoing financing of the basic things in life will be permanent. It's continuous. Just take care of that. In all of those illustrations, we've said it before, but I'll say it again. In all of those illustrations of becoming your own banker, those people are financing the things they were going to do anyway. They were buying cars, they were purchasing equipment for a vehicle, and they were passing on money to grandkids. That was stuff those people were going to do anyway. They just did it in a way that was relatively superior. If all you did was that, and that's why where we started this, I was so glad, and I knew what you were doing when you were talking to Becky and Jerry, where you were mentioning that it was something you knew about. Yep. Where it wasn't about real estate, because it's so glamorous and wonderful, and everybody should be a real estate investor. Right. By the way, the real estate investors love that, because everybody who doesn't know what they're doing gets to come play in their sandbox, and they eat your lunch, and so too do the bankers. Okay, so look, if you're a real estate investor, I have legitimate real estate investors, agent investors. And they do well, and that's wonderful. By the way, they're the first to tell you that the revenue generation from that is hyper cyclical. It can be wonderful one year, and it can be like in the next year. They'll be the first ones to take caution to that. And so, but then on the marketing side, to tell to tell the people that all you got to do is go get that mailbox money, go just buy the home and then rent it out. I made a point once, I think on maybe Facebook or something that, it was Facebook. People talk about things like real estate investment, alternative investments, as if it's just an alternative to a stock purchase, right? It's just a decision. I'm just going to do this instead of that. I'm just going to make this purchasing decision. When in reality, it's kind of a second profession. You want to go manage 20 doors? You're going to go manage the maintenance guy or guys, because there's going to be multiple of them. You're going to monitor all the tax situation. You're going to take care of all the repairs or manage the crews that have to do all that. Okay, then go ahead and scale that up. Maybe it's 100 doors. What then? By then, that's not your second profession. It's your profession.
Oh, before then.
Yeah. Well before then. Yeah. And so, but there's this idea that, all I have to go do is, just make this, I'm not going to do the stock market. I'm just going to go buy real estate. No, it's a whole second. And so what really matters underneath all that is whether it's something you know about. And that was so key. And what you really know about is what you're already doing. And what you're already doing is financing cars. And by the way, paying cash is also financing. You're giving up interest and dividends you otherwise could have earned. Okay, so don't hop over that. Right? You're going to purchase vehicles. You're already planning for retirement. That's another future form of need for capital. You're already doing that. Might as well incorporate that into IBC. You're paying on a mortgage. Okay, if you got kids, they probably need stuff. If you're married, there's going to be gifts. There's going to be trips, right? All that stuff is getting paid for. Ask
continuously, you have a daughter? Oh, okay. Young daughter. Do you have any idea what weddings cost today?
Yeah.
I mean, let's don't jump over that.
And give it 10 years and add a zero. I mean, it's not going down. I mean, the need for capital is only increasing. One major, and I haven't really argued this out before, but one major implication of illustration 6 in equipment financing is that as interest rates go down, which, by the way, means as inflation gets worse, right? As the price of money is manipulated downward, money gets cheaper, which leads to inflation. Okay, as that happens, what was the result? What was Nelson's recommendation? It was to pay more premium. And so as things get worse, economically speaking, out there in the world, the need to capitalize, the need to control the banking function only becomes more urgently important.
Yep.
And so it ought to be more premium, and not just more premium like you don't have the money. I mean, a reasonable, appropriate premium determined with a competent advisor, like all of that's not off the table, but we're all catching up, and I give people all the time, I wish I would have done this earlier. I wish I would have done, and a lot of my clients are older than I am. And so one guy last week said, "Oh, gosh, I wish I would have figured this out when, like when I was your age." And I'm like, yeah, well, I wish my parents figured it out.
Right.
And my grandparents and their parents and their parents. Like, since life insurance is older than the country, I mean, the asset was available. So we're all catching up.
Yep.
We're all catching up, and things they're not looking great. They're not looking too hot on the world stage. So the need to control capital is only becoming more important.
It's going to continue to be a need and a greater need in the future. But, going back to the Becky and Jerry and Becky, the real estate, doing something, which I appreciate you catching that and pointing it out and bringing it up. That is the opposite of the marketing in the real estate world, in the infinite banking, because now all the real estate groups have people who quote unquote do or are experts in the infinite banking concepts footprint, and then the marketing programs that, here, do this to go do that, and, sell the HELOC or whatever, buy a life insurance policy, collateralize that to go buy, an appreciating cash flowing asset. I mean, it makes for a wonderful presentation. But when you get practical, I mean, my wife doesn't want to manage real estate, and I don't want to manage real estate. And then if you look at the internal rate of return on, real estate or any other asset over time and compare it honestly with what, is done with life insurance, I mean, it's a hands down, you're going to win, right? And my point being is like when I retire, because a couple of years ago, the solo 401ks were so popular.
Ooh, a new government program.
Yeah, you're eligible to get $50,000 past the government regulators. Well, it's really about, I'm paraphrasing, right? And then the retirement plan, the self-directed IRAs, go buy the real estate. When you're 65, when you're 55, do you really want to start leveraging, probably the most liquid asset that you have and put it into real estate or any, it's like, yeah, I know.
My intolerance for that kind of thing right now at my age is so low. I can't imagine how low it would be at 60 or 70. My grandmother, who is a client, has a home in West Texas that she does Airbnb with. Yeah. And the story is, a call in the middle of the night, toilets are overflowing. There's sewage on the ground in the home in the state that I don't know.
And this is our vacation.
You want to deal with that? Because waking up, call the plumbing company, coordinating from hundreds of miles away. Nothing about that sounds interesting to me.
It's not all bad.
I'm sure it does. Some people may have grew up in it, or they were agents, or they're carpenters, or plumbers, or natural electricians, or they're handy, and they like that. Thank God, because somebody's got to do it, and it ain't me.
It's like I think I brought it up on an episode. Maybe it was with the Stringers, but I talked to a young man out in the timberlands, and he's a client, friend. He's like, James, I work with guys that are, they're like highly educated. Some of them have finance degrees. And he's out working, 40, 50 hours a week, young family, getting it done. He's a mule on the ground, making it all happen in the organization that he works with. And he's like, and if I talk about this or try to share it with them, they just almost hostile. They just don't get it. I can't even talk to them, which is all very common, right? But, he has friends that do timber, which Nelson, he was a forester by trade. So the guy buys one of his acquaintances, buys property, harvests the timber, and that's what he does, right? And so this particular situation, he had to offload a piece of property, several hundred acres, to be able to do the next bigger deal that he wanted to do. So the infinite banking client, Fred, he leverages the policy. I don't know if he could do the whole deal on the property, right? But he got the property. So the other guy, this is capitalism, man, at the enemy level. I love it. Then he finances a bulldozer straight out of his policy, repairs it because he has that ability, improves the property with like roads and gravel. That the gravel existed on the property, right? Puts gates up, improves it, holds it for about 12 months or so, sells it for a beautiful profit, and if you're looking at volume and profits and cost, and it was double digits, right? And then he turns around and sells the dang bulldozer that he purchased and repaired for a profit.
Where's the, hacker YouTube video explaining that,
Well, I got to get him to come on the show. I don't really want to tell the story, but it was like, that has sat with me, because I love people sharing, their experience, how they even get here. And really, talking about Jerry and Becky coming on here, I got to say that, we got a lot of clients and, a lot of them can't come on, from their profession or their, who they are in the public, and most of them don't want to come on, because they don't. No, I don't want to share. I don't want to.
Their business.
Yeah, and they don't want to say something wrong or what have you, or my story might not be valuable, or or maybe they're on the other side of the country, and whatever the case may be. But the people who do come on, I'm very thankful. I'm very appreciative. We generally have a conversation right up front. But number one, this is unscripted. They don't get a bullet point of questions that I'm going to ask. They don't get a bullet point of things that they're going to talk about. They can take their notes and do whatever they want, and they can share whatever it is they want, right? And we do have the power of editing, but we make an effort not to edit, right? And so my whole point here is unstructured, it's unprepared, right? It's the real them and their experience. And I say that's where I see the value. People do want to know what you're thinking and what you've done. Yeah. And I want to know your thought process that got you to here, that's caused you to do what you do. And that conversation prior to the cameras turning on is very limited. Do you want us to use your last name or not? And I would prefer not to mention life insurance companies by name.
Yeah, very basic.
That's it.
Yeah.
So whenever they come on and share, it's like, man, and I'm not selling anything but books and education, right? If you want to become your own banker, perfect, call my office. Then I'll sell some life insurance, and I do sell a lot of life insurance, but I buy a lot too. I'm just as a side note, there's not a promotion of merchandise or things, it's like, it's just very non-promotional. Anyway, I just wanted to share that because we literally walk in and sit down. You might make some notes here, you might listen to something on the way down here, but I think there's value in that, and I want to bring that up too, because I rarely listen to episodes, right? I just don't, I'm too much of a self-critic probably. But she asked a question about the rate of return or an interest rate that they get on notes, and then the dividend that they get in a life insurance. Did you listen to that part?
I did.
I made a mental note that it's like, I didn't want to, when you open a walnut, you can gently open it, or any other nut, and get the fruit and the meat out, or you can take a sledgehammer and smash it and not enjoy it, right? That's Norm Baker, okay? I didn't want to answer the question with a sledgehammer, but
I love Jerry's response.
Me too, because
I don't care.
Exactly.
The access is more valuable.
Yeah.
But and all explanations in a sense are going to be partial with a question like that, because there's so much that you can talk about. But gross dividend crediting scales or net dividend crediting scales, it's a percentage of the relative to the invested assets of the company at the company level for that year.
So
that's that percentage.
If a life insurance company earned a 5.2% rate on their invested portfolio, that's what they might ought to share with their other owners of the company.
But then the relationship between that number, that margin at the company level, the relationship between that number and an individual particular policy owner is indirect at best, right? And then you cannot talk about a dividend percentage of any kind with respect to a particular policy, because it's a percentage of what? Of the cash value, of the premium, of the death benefit, of all three things valued together? In what year? This one, year 5, year 10? Is it, if it's a future year, is it discounted to the present? At what discount rate? It doesn't matter. And that the companies fall over themselves declaring these numbers, and they have
that's another 100-year-old argument. The life insurance company beat each other up after falling all over themselves. Well, we pay a 6% dividend. They only pay a 5, or they pay a 5.5. Well, we pay 6.1.
Yeah, our dividend scale went up 1/10 of a point, and theirs didn't.
Yeah,
and I care. And. So it's anyway the dividends. That's just it's a rabbit hole you can go down all day. But at the end of the day, that dividend crediting scale number is irrelevant in my view. Now, if we're talking about direct recognition versus non-direct recognition, it's a whole nother question, right? Because we could talk about dividend crediting scales in a non-direct versus a direct recognition scenario, and that adds another layer of cost, of indirectness, right? Because, do we have a loan outstanding on that direct recognition policy at the end of the policy year? And how many policy years will there be a loan balance outstanding? And what will be the total reduction in dividends and therefore cash value growth because of those loans? Oh, nobody knows? Of course not.
Well, just take the policy down to the bank and keep your
cash
dividend.
Line of credit.
Yeah.
So we can be dependent on the banker.
Line of credit, whatever. Yeah.
Violate Nelson's rules against doing business with banks. Yeah. But we do ABC, right? Well, the last thing I want to say about Becky and Jerry, they talked about when they met. They talked about when they got started with IBC. I think was it 2014 when they met you? or maybe when they started IBC.
I think that's when they started IBC. They didn't
later.
meet me until 2016-ish.
Okay, perfect.
Like
so
that.
even a tighter timeline. So
I don't think they become a client until like 2017-ish. Yeah. I don't know.
And Jerry said, I think at the beginning, late 60s was his current age. And so we think 2014, okay, that's 8 years. Okay, so 8 years from where he said his age. Okay. And then one thing they both said was how surprised they were at how much they could do in so little time.
Yeah.
And knowing what I know about how cash value growth, I know very confident that the cash value in those policies is probably not in excess of their cost basis if those policies are only 8 years old.
No.
And yet, look at all they did.
Yeah. There's nowhere to put that on a life insurance illustration. I mean, I'm pretty sure he shared it that they're building a home, right?
Yep.
Yeah.
I love that. I could tell the builder to take a hike. Yeah. Oh, I love that. Survey? What survey? You mean the one the lender wants?
What?
Yeah. And the builder doesn't even, huh?
What?
We're going to pay cash, pay as we go, huh?
What? What do you mean you don't need a mortgage? It's like the ancillary conversations that causes within all the professionals, the builder, the closers, the wannabe lenders. And
yeah, what's that worth,
Oh my gosh.
Just the savings on being able to, renovate the bathrooms or whatever, improve the value of the home you live in or whatnot. What's the value of the cost savings and the authority of just being able to use loans to do that?
Yeah. We moved a couple of years ago, my wife and I, my family, right? But it's only like 8 minutes away. I'm right here. National coverage, local service, right? Just saying that. And I had this conversation with Nelson. So we lived in a home. We lived there a long time, 15, 17, 20, a long time. And so, it needed an upgrade, needed a facelift on the kitchen, the bathrooms and all that. And, we're looking.
I remember that. I remember that whole project.
Oh my gosh. And it's like, well, if we know we have to improve the property to sell it whenever we eventually buy.
We're going to have to do it anyway.
Yeah. So why not, if we're got to be here, let's build a pool, and excuse me. So that'll make our time that we have to remain here, funner.
Enjoyable. Yeah.
Yeah. And so we did, but just the whole conversation of that, I could do a cash out refi because I've done them before and paid PUA premium. There were particular circumstances in which I did that. Could have done it again. And so here I'm justifying all this to Nelson. Nelson, I'm telling him the whole big story. We're going to build a pool and, I don't want to go get a second mortgage. The idea of getting a second mortgage on your home to put a pool in place or solar panels or anything like that, talk about repulsive to me. It's like, ooh, why would you ever? Only because you have to. Okay, there may be a better way. So anyway, and I'm trying to justify my whole process. Look, I got a new banker because my banker died. I became an orphan. They got a replacement. He's a great guy. I can educate him, like I need to educate him, right?
Yeah, you need a second job, yeah.
On how, life insurance works, this type of life insurance, and going through the direct and non-direct. You can go out and get a whole new crop of potential prospective clients because they work for these great companies that shred the dividend when there's a loan. So, and then, of course, have the conversation if they ever, if you got to foreclose on that. I mean, I'm a buyer, no question. And I'm going through all this, and Nelson just as gracious as he can be. It's like, yeah, it'd be I think the third cash out refi I did, and and then educating the banker, and then I'll do great big illustrative presentations on how you can do this. And that was also the time when it kind of got around, or the buzz was like, oh, you can't take first year policy loans with some companies. I don't care. The banker can do whatever they want, right? So I was going to address that, and potentially use one of those companies because I own them, policies with them. And I go through all of that. And Nelson, I'm just telling you, he's like, yeah, sure. Yeah. Oh, that would be great. So, it'd be, so altruistic of you to do this and to do that, And it's like, no, we just financed it straight out of a life insurance policy. I didn't have to go through any of all of that. I avoided all of that. And I'm like, what was my thinking? You get dipped in the grease all the time. And if you got to wipe this thinking off of you, you know. Anyway, thanks for letting me share that. But we enjoy the pool, having the property, you know, enjoy that, whatever. You know, we're going to do some remodeling there. Already have done some. We're going to do some expansion. The builder's like, we've gone through a couple of builders. The first builder's like, you know, like there's kind of excessive questioning on, you know, the mortgage and all that. And I'm like, listen, my wife's got plenty of money. Don't worry about it, you know. And he couldn't fathom that there wasn't going to be a mortgage lender, you know.
Yeah, the way they side-eye you. I mean, I was looking at I did get a different truck recently. I think I told you this. And
it's a whole other podcast that I can't wait for you to listen once we record it.
The salespeople are always, they're so worried that you're not able to pay, right? That everything's going to go well. They're going to do their job. Everything's going to get done, and then it'll fall through in
they won't
finance
get paid.
Qualifying, and they won't get paid. And they're so concerned. Yeah. And I have to tell them, I'm like, listen, it's going to be okay.
It'll be okay.
You know?
You need a hug.
Yeah. It's a different world, you know. It's like going and visiting another country. Like we live in IBC land where things are peaceful, and then you want to go get, you know, champagne in France. You got to go to France, and you know, there's the language barrier, and you got to have it.
I'll endure. I'll bypass the champagne, but I'll endure the trip to France. You know, I'll suffer. I get it though. All right.
Anyway,
you're like side-eyeing the clock over there. You must be hungry.
Yeah, the one that I didn't even start. So I don't know how long this has been, but it's been good. And I really enjoyed Becky and Jerry. I'm glad they not finally, but I'm glad they came on.
That's a proper use of a word.
And shared their experience. That was very good. I think it'll be really helpful to people. The AV guy was telling me before we hit play here that it's doing good as far as viewership. So seems like people are interested.
I'm convinced that on my channel there's different playlists, and I think there's guests, which are outside, maybe economists or like friends like Barry Dyke, and they may be agents, advisors, they may be economists or historians.
Non-client guests.
Yeah, non-client guests. Thanks for simplifying. And then there's a Q&A. I mean, there's our book review. And then there are guests. And I'm thoroughly convinced, right, if you just listen to other people's stories, it will help you. And it will save you a lot of time if you're wandering around in the no man's land of TikTok. You know, it's almost
Chinese
like
no man's land.
Oh my gosh. And you don't even have to give all your data to the Chicoms, right? Give them to the neocons.
Just give it to Google. Yeah.
All right, look, I had fun. Thanks for listening.
Bye, y'all.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.